I'm very lucky to be joined by Dan Draper, Invesco's Global Head of ETFs, for our next session, kind of on the future of the ETF industry. Dan is a great person to weigh in on this, having spent more than a decade in asset management, most recently leading Invesco's ETF business from Chicago. There, he steered the firm through several acquisitions at home and abroad, securing Invesco's position as the fourth largest issuer in the US with more than $200 billion in assets. Prior to joining Invesco, Dan held an asset management, wealth management, and investment banking leadership positions in New York, London, Hong Kong, and Jakarta, working for the likes of Credit Suisse Asset Management, Lixor Asset Management, iShares, Goldman Sachs, and UBS. So I'm looking forward to getting his perspective on how things have changed and where we're heading next. Now, before I pepper Dan with a million and one questions about how the ETF industry is evolving, I want to ask the audience one about the most talked about development this year. A new type of actively managed ETF that will trade intraday but publish its holdings once a quarter like a mutual fund. You heard James just talk about some of Bloomberg Intelligence's thoughts on active non-transparent. So the question that we're going to be polling you on this morning is, do you expect to buy an active non-transparent ETF over the next 12 months? Do you expect to buy an active non-transparent ETF over the next 12 months? Yes, I'll be there as soon as they're available. Maybe I'll consider them, but I need to be convinced. Not for at least 3 years, or no, I never will. And so far, people are interested. Okay. Okay, so people will consider them but need to be convinced. Now, I don't know whether that's due to some skepticism about the structures or just sort of a lack of information, but Dan, I thought that would be a good point to kind of dive in on. You guys obviously run active transparent ETFs, yes, along with a bunch of kind of passive and smart beta products. But how do you gauge the appeal for active non-transparent products?
Yeah, I think certainly for kind of our leadership position and having built scale, I mean, we want to be able to offer all types of investment options to the widest client base we can. So we think about the ETF in two parts. One is obviously the wrapper, and the second part is content. And if you think about other industries, for example, media or other areas, that the development and the value of the content tends to be really where rather than the pipes where the value is. So I think continued innovation and thought around enhanced content, and then frankly democratically allow voters and, or in this case investors, really to decide which is the best content for their clients or for their portfolios is crucial. As you mentioned, we launched at Invesco the first transparent active ETF. It was on a real estate strategy a number of years ago. And I think that when you go through that process and you're working with active teams, you do need to think there are kind of two components. There's going to be an active portfolio construction component, which is kind of the bread and butter of portfolio managers, active portfolio managers, but there's also a separate component of implementation, and that could be active as well. So I think what you're looking at is really, particularly when we did our transparent active, it was rules-based to some degree, but having the transparency every day of the holdings. But that's where, when you move to the implementation, that's tended to be where it was more active. And I think the skill came in of being able to kind of implement. So this is interesting. So when you think of the non-transparent active, be able to kind of marry together active portfolio construction as well as hopefully some alpha or outperformance capability on implementation. So we certainly intend to offer all those options to clients, but look, education is going to be paramount to really, I think, getting those products off the ground.
Well, I want to dig into the kind of active implementation side in a second. But first, in terms of kind of the types of clients that might benefit from an active non-transparent structure, who do you kind of see as being kind of the sort of, the real clientele that's going to find those compelling? And are those the same or different to those that you think buy the active transparent products at this stage?
Yeah, I mean, we're obviously going through the process now on a client channel basis. I mean, I wouldn't say that we're aware of a huge amount of pin-up client demand, much as kind of the survey indicated. But I would imagine that on a retail or intermediate retail, clearly taxable accounts are going to be more attractive for obviously the tax benefit of ETFs, probably retirement a little bit less so. And I think I would expect particularly kind of mutual funds to continue to do reasonably well in that retirement space because of obviously the tax deferral nature of that. Then I would say institutionally, it's going to be interesting because I think that's where, again, many institutions that use active strategies, many of them use separately managed accounts, for really large scale. But for those who need a unitized product, I think that's going to be a huge amount, again, education about, it's exchange traded. What are the benefits from that? The idea of price discovery. And also, if you think about once you create an ETF and it becomes a listed security, there can be inventory or lendable value in the actual ETF itself. So once it becomes and moves into that security ecosystem, it's really an interesting dynamic. And I think particularly in fixed income, that could be an area where you could really kind of educate institutions on maybe getting repo or lendable value in addition to just simply owning the ETF.
Well, that's interesting because you alluded to this a few minutes ago just in terms of the active use of ETFs. And I'm curious, obviously you've been in this business for a number of years now. How have you kind of seen sort of the use of ETFs kind of changing?
Yeah, I think really ETFs have, in today's world, become really microprocessing chips within a larger solution or portfolio management. And I think that as you saw all the stats on all the traditional market cap weighted spiders and Qs and all of those, really have been popular for a long time for a lot of reasons. But now, as smart beta has grown and other kind of tilting strategies, you're now starting to see them holistically included in multi-asset class type solutions and sitting alongside active strategies as well as alternatives. So I think it's, for me, over the decade and a half I've been involved in ETFs, to really see, to say they've gone mainstream would be an understatement. It's much more to when you're having a discussion, about building an efficient portfolio. It's not so much, do we include an ETF? It's really how do you reach that client outcome? Mm-hmm. And it just becomes more about which instrument. So when you're doing all the screening, let's look at active mutual funds and ETFs and really that whole methodology. So I think it's just become really ubiquitous with investing.
Do you think there's a sense to which kind of the ETFs have sort of moved beyond those kind of building blocks for portfolios as well, and that people are starting to think about them a bit more sort of tactically as well?
I do. I think clearly, this, I want to say unusual market or monetary environment, but it's been over a decade now. It's really, really hard, particularly in the public markets, to diversify. And I think particularly we've seen, the huge move in the yield curve, especially the longer dated 10-year Treasury going from 3.25 down to below 1.5 over 18, 20-month time period. That's a huge amount of volatility. And if you are, especially a retirement or saver, you need income, or likely you want income. So you almost by default have to go into dividends. So how do you do that in a way? Do you do it defensively? Are you looking for growth? Are you looking for, even within a dividend strategy? So even though there are ETFs that have these dividend labels, I think, as you saw earlier, just the labeling and actually the way they're constructed, the way they rebalance, all those nuances, it can be as varied as different active strategies. So being able to kind of understand that, in today's environment. And then obviously, there's huge demand for fixed income. And again, a relatively low yielding environment. How are you able to, use fixed income? And that's probably where tactics or tactical asset allocation, at least at some portion of the portfolio, is gaining in popularity. It's almost out of necessity.
And Corey Lang on our first panel today sort of talked a little bit about some of the trading uses of ETFs. I'm curious, just kind of from a sort of portfolio, but maybe a bit more nimble, the uses that you kind of see ETFs as either like a liquidity sleeve or kind of as a cash management tool. Can you talk a little bit about kind of how people think about sort of using these for very specific purposes? Yeah,
well, again, throughout the kind of client ecosystem, even the most sophisticated institutions, they're going to think about, even if they're going to use a separately managed account, for their long-term strategic asset allocation holdings, just because simply it's cheaper, it's customizable. But as they look through transitioning or rebalances, they're going to be looking and comparing their trading desks, at least looking at ETF alongside a futures contract, or if they look at other Delta One, swaps or other type solutions. So this is really where, again, that dual nature of, yes, it's a fund and an investment, but also it's a listed security. This is where increasingly now the liquidity, and in particular, as we've seen, with particularly banks and other market makers with less balance sheet over the past 10 years, this is where those liquidity benefits of ETFs have really become even more paramount. And that's particularly in areas like fixed income. We still think it's really early days of the growth, and a lot of it to increase the trading volume and liquidity. That's a really valuable form of risk management.
Yeah, well, I think one investor once said to me that they think about this kind of like a dashboard. They have ETFs kind of alongside securities, options, derivatives. There's all the different options that they can then use for particular kind of strategies. Thinking about less of the institutional and more of the kind of financial advisor side, model portfolios have certainly generated a lot of conversation within the ETF industry. How do you guys think about that as a distribution channel, and what are you seeing financial advisors looking for there?
Yeah, no, it's hugely important because at Invesco, our focus historically, when the old power shares business was around, it wasn't called smart beta, but that's kind of our roots. And I think back when power shares was started in 2002, 2003, most of these model home office models and other portfolio managers were obviously dominated by active mutual funds. But also, if they were even going to consider, which they didn't until later, an ETF, it was going to be around market cap weighted, just because of the nuance. So we really, our business took off initially through the registered investment advisor area. So these were independent RIAs who were less benchmark constrained. So they could look at a theme, or they could look at a smart beta strategy that perhaps had a bit more benchmark risk, but they were willing to take, and frankly, in some cases, more tactical asset allocation approach. But over time now, being able to build out kind of the scale that we have, the growth of home offices has become crucial, and they're very much, we treat them in the way we cover and engage on a due diligence basis, and they're a sophisticated institutional buyer on behalf of financial advisors. So we have a dedicated team at Invesco, that holistically covers those clients. And clearly, with at that time, 3 years ago, when the DOL fiduciary rule, was being considered, there was a huge shift in terms of resources and focus. And I think that kind of prompted, but at the same time, there's still a lot of legacy brokerage, assets. And I think that's where, for us to be, as responsible, how can we, if brokerage will continue to move to those fee-based advisory home office models, how do we kind of follow the money in motion, and how do we really kind of support, as that change continues? But yeah, we see it as a long-term secular change.
What benefits would you say that kind of an ETF model portfolio gives to a financial advisor?
Yeah, again, I think the customizability, and I think this is where, as we know, in larger wealth management, the other trend which will continue is to continue to focus on holistic wealth management and financial planning. So if you look at all of these requirements on a financial advisor, especially the time commitment, frankly the lack of time that an average financial advisor has with all of these needs, I think the ability to feel that they're going to be able to offer a client, every client, a customized experience dedicated to the outcome they want, but be able to do it in a way, and I think that's where the building block nature of ETFs. If you need more income, or I want low volatility to sleep better at night, or I believe that commodities can help me diversify better for paying for my retirement. So all of these kind of mixture together, when those financial advisors increasingly are facing, how do I help my clients with insurance, estate planning, taxes, or even if they're not giving those advice, they're using time in their network. So this is where, again, I think that component part, that outsourcing, and ETFs and the efficiency, customizability, ultimately is going to give the financial advisor hopefully more time to spend with clients, again, in this holistic, financial planning process they're engaging in.
So on that efficiency point, I alluded in introducing you to the fact that Invesco has been involved in a number of acquisitions over the years. You've been a big proponent of scale. So could you tell me a little bit about why you think it's important to kind of have that scale, and how it kind of helps you do the work that you guys do?
Right. Well, I think it was interesting, the previous presentation, that you can see the number of launches and ideas for new ETF businesses or even products. But unfortunately, I've been as well. I've, in my past, personally bought thematic ETFs that didn't make it, and going through the process of something that's being closed or something that I really liked or whatever. And I think that's where having an established player or group of them with track records, and crucially to be able to kind of reinvest back into the business. And this is where you see, our business every day is becoming more like a software as a services company, where the systems and being able to kind of lower cost ultimately, we hope for investors, but just basically to improve risk management. You have to be able to kind of, I think, have enough scale to be able to kind of reinvest back in the business, thinking about new product development. And then if you want to be a global player, which we are, it's interesting, you have these global securities which can be bought and purchased around the world, but then when you get to the wealth management markets, they're very different. The different taxation and different regulatory treatments. So this is really where, being in Europe, for example, under the UCITS rules, but even within UCITS, you have the UK and France, and so all these different kind of areas. You really have to be able to offer clients scale, and particularly in markets like Europe and Asia, which are really dominated by more institutional investors. If you invest a lot in a sales force, but you really have subscale products, the response you're going to get is, well, just come back to me when you have, a handful of ETFs with more than $100, $200 million of AUM. So it's really chicken or egg if you're thinking globally. And so that's where, particularly in Europe, we bought the Source business, which at the time was the largest independent player. We tried really hard for a number of years organically to grow, and we had really interesting products. But until we could get the size of the AUM of the fund and obviously the trading liquidity as well, it was really difficult for those large institutions who buy the ETFs in Europe to really consider our range. And this is where being able to acquire a firm which not only had really interesting products, but also they had the scale and on a multi-asset basis. Because when you go in, you also ideally want to be able to talk about multi-asset class solutions. I came in to speak about our new we have a blockchain ETF in Europe, for example. I want to talk about that, but by talking about asset allocation, you find out there's huge demand for U.S. Treasury ETF, for example. But being able to holistically talk to the client is really important in those parts of the world. So that's why the acquisition in Europe was more getting to scale, regionally focused. And then here in the U.S., we bought Deutsche Bank's commodity ETF range about probably 4 or 5 years ago, and then Guggenheim's ETF business. And those were really driven more by the content. If you think about, I gave that analogy earlier around media, content is crucial if you're Netflix or Hulu or any of these other providers, and the same thing is increasingly as we think about our range, making sure we have premium content that we can offer. And that's where Guggenheim was really interesting with the bullet shares technology, final maturity fixed income, which again, we think has really long-term opportunity. We had the leading, and still have the leading, single factor S&P 500, but we thought, well, Guggenheim had the S&P 500 style. What a nice complement to get factors and style together in one place. And as I mentioned, I think Deutsche Bank was commodity. So that was really content-driven. And then most recently in Oppenheimer. So all of these each acquisition has different kind of rationale, but when you pull it together, it's being able to really have diversified content. At the same time, you're thinking about your distribution as a business and how can you really have that scalability to talk to clients on a relevant basis.
So what challenges would you say you've kind of encountered in choosing to grow via acquisitions rather than sort of internal growth, which I guess would be the alternative model?
Yeah, it's culture and people. I mean, everything looks great on paper and strategy, and I know there's a Harvard Business Review just across the river, an article that talks about really where, in most cases, culture and values eat strategy for breakfast. And I think it's definitely the case. But I think that's where trying to have kind of the vision of where the market's moving, but not only you get this great content, but then you have to have the people come in and support, who have the history with the products, the indexing. Because as I said earlier, a lot of the products all have very similar names, but when you look in the attribution, they can be very different. And kind of the history behind being able to kind of educate, and it's going to be even more important with active, non-transparent, obviously. That's where really having this talent to go through, on the one hand, the content, and then if you think about the wrapper, like our ETF capital markets colleagues, being able to explain the liquidity, the implementation, all that is very nuanced. And so whenever you make these acquisitions, you really want that talent to follow, but at the same time, you need to really kind of integrate and have everyone facing forward, especially as competitive as ETFs are.
And what would you say kind of sort of having scale kind of brings in terms of advantages to the end investor? Are you able to make efficiencies there in terms of your pricing?
I mean, it's possible. I think, I think for us, if I look across our range, again, we're a little bit more nuanced because we're dominated more by smart beta and factors. I mean, I think on a Morningstar basis, in our comparable categories, we're in the 46th percentile on pricing, so we're below average pricing. So we always watch that closely. But I would say overwhelmingly, the acquisitions we've made to date have not been about, it's really been about providing, either getting content or regional access to clients. And the relevancy comes because when we have, frankly, bigger and better product range to talk about, the depth of our discussions with clients just increases. Like now having commodities, for example, from the Deutsche Bank acquisition, in a market that's very hard to diversify and lower risk, we can have, even though, well, up until this week, commodity prices had been a bit modest over the past decade, now we can really engage around diversification. And clients who want to talk about real assets today, we can talk about real estate, we can talk about commodities on that basis. And I think that's where just having the bigger scale and the global scale. Frankly, our colleagues in Europe are really leading us in the ESG discussion today. So we're really kind of leaning on them to help us here in the U.S. And elsewhere as they really make progress and have they're more further along on a client basis. So I think that really just helps you become more relevant overall, the scale.
Sort of having more strings to your bow, I suppose. Yeah.
But again, if we can, and this is where we are on top of the efficiencies, that's a huge competitive advantage, and we clearly want to make sure that we can pass those back to investors over time.
I mean, you guys aren't obviously the only folk in the industry who have been consolidating. Do you expect to see more consolidation within kind of asset management and the ETF industry specifically?
I think so. Yeah, I think
there's still targets out there, potentially.
I think there are. Obviously, like I said, I do think the culture, is crucial. Regulations obviously varied, but I do think that in general, where you particularly have investment processes that can be made more systematic over time, obviously ETFs and indexing fit in that category, then I think it does make sense. But at the same time, you see on the barbell big opportunities, and alternatives, and I think high conviction, high active share, active as well. There's real opportunity, I think, in both. But I do think, like many industries, you are going to see scale increasingly matter, in asset management.
Can you see Invesco making further acquisitions?
I can't comment. We've got our hands full at the moment. That's all I can really say in terms of just growing the business now. But but I think we've been very fortunate. What I will say is I think Marty Flanagan, who's the CEO of Invesco, if you look at kind of a competitive competence of successfully not only buying power shares in the day, Van Kampen, and the other kind of acquisitions, most notably Oppenheimer, it's not easy. And I think, but that's where if you have that, if you kind of have a strength in organic areas and a track record, because it's really hard to do these deals, I do think it's something that adds to it. But I think very much kind of the organic growth plan that Marty and our senior management have put forward makes a lot of sense. So all of our focus, certainly in ETFs today, is really just to take this great product range that we've grown, we've bought, and really pull it together with a great group of people and continue to, as I said, just stay in front of our clients around it.
I mean, you've mentioned Europe a couple of times in the conversation. When you kind of sort of look ahead to the next sort of few years, I mean, do you see more focus and growth coming out of the US or potentially out of other areas in the world?
I mean, you do tend to follow global, I think, growth, and I think clearly the US, at least in the developed world, is still growing the highest. I do think, particularly in areas like fixed income, I mean, I know it sounds basic, but just having positive government bond yields is a big advantage. Yep. So that's where even our UCITS range in Europe, a couple of our biggest inflow products in ETFs have been in U.S. Treasury bonds, not surprisingly, when you have so many negative rates, especially in places like Germany. So I do think the U.S. almost by default in terms of overall growth and inflows. But I would say in terms of just more percentage growth from a lower base, I mean, Asia, continues to move ahead. And for us, it's amazing to look at, particularly the growth in digital wealth in China, even with trade wars and everything that's happening, but looking at the way that, frankly, money is moving and payment systems and now moving their way from payments into things like money markets. And that's going to be a leading indicator into, more risky asset classes, including smart beta, and those strategies. So I think China is an area where, fortunately, Invesco has we have a pretty strong presence through a joint venture there. And we've launched, I think about 6 or 7 ETFs in mainland China through this joint venture in the past. That's a huge area. And again, being able to learn from that market as now the digital wealth platforms, really start to expand here and places in Europe, it's going to be really, really interesting. And again, I think the ETF wrapper, it is a digital, for me, it's a fintech innovation. And becoming, again, that component piece in so many different strategies, as I said, and we're already starting to see not yet, but the potential for money markets in China and things like that. How can ETFs play a role? And that's the other thing I would say, that the negative government bond yields in much of Europe has slowed it down. But I do see once we get to a more normalized nominal interest rate environment, ETFs, I think, have a huge opportunity to play in generally collateral needs globally. And this is something, again, with balance sheet reduction by banks and commitments, but still the growth of derivative use and everything from foreign exchange and obviously equities, fixed income. But that's where I think ultimately that ETF wrapper and that dual nature of an investment, but also it's a security, has a real opportunity to play in collateral markets globally. It does some today, but I think it's going to play an even bigger role in that going forward.
So the future looks bright.
I think so, yeah, a lot of opportunity. And well, it's a thing that whenever you do have market pullbacks, it does seem that, ETFs are able to step up and to find a role to play, once you get the market recovery.
Well, I'm afraid that's all we've got time for. So you're left with even bad news is actually kind of good news for the ETF industry, which is a nice place for us to leave things. Please join me in thanking Dan for a really interesting conversation.
Thank you.